The monetary system as it is, it's not sustainable. The higher the inflation gets, the higher the need for a new kind of monetary system will get.
Please join us for our next live stream Sunday, June 12th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, June 12th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Mark Valek joins us once again today. Mark is a partner of Incrementum AG and responsible for portfolio management and research. His passion is to apply interdisciplinary research to investing, and he is particularly fascinated with the Austrian School of Economics, monetary history, and the foreseeable paradigm shift in the monetary system. And we're delighted to have Mark join us once again today. It's time to saddle up and silver up for Mark Valek. Mark, welcome back to SBTV. How are you doing?
Hi, Patrick. Thanks for the invitation. I'm doing well.
Great, glad you're doing well. It's been a while since we had a chance to last speak, so should be interesting here. After reading your most recent In Gold We Trust report, one thing stood out was a mention of a comparative economic study between Rome, which suggests the world is on the precipice of a turbulent transition from an old world order to a new one. Why would this transition be seen as turbulent, and what would make it turbulent?
Yeah, that's a big question, which implies a lot of knowledge and a lot of ideas behind that. But I think it's safe to say that we are currently living in very turbulent times. Everybody knows that. And also, when one thinks like in terms of geopolitical spheres or power spheres, I think it's also pretty obvious that things are starting to change or changing. And when it comes to Rome, I mean, this is a very interesting showcase, obviously, because we had a great change there happening roughly to 260, 270 AD. And that was basically the time when the currency there lost a lot of value, was kind of some kind of a hyperinflation, high inflation, definitely, after a lot of dilution and debasement of the money there. And this is, I think, one characteristic which typically also occurs during these times of changes. And that's why I think this case is also interesting, even almost 2,000 years later. And we are experiencing high inflation, high money devaluation right now, and we are looking at a lot of geopolitical power struggles now. So I think the analogy is quite interesting to have a look at that.
Decades ago and even up until today, we hear the words New World Order. Hang in there now. And it's often dismissed as conspiracy. But why, over the decades and after hearing so many world leaders continue to utter these words, New World Order, why is there still seemingly a large segment of the world who believe a New World Order is conspiracy or fiction, but not fact?
Yeah, again, also a very big topic. I mean, if one listens to politicians, as you already said, this term frequently comes out, new world order. And I think this term means different things to different people. So if one thinks about, like, I don't know, want to call it the power elite, but let's say powerful politicians who are really are in position to form global orders. They think geopolitically, geostrategically, and they discussed also this kind of terms. And I mean, as far as I understand it, one can look into history, and there are some pretty clear inflection points where one basically can identify a change in a world order. I think most recently, in the last 200 years, there was 1850, the Congress of Vienna, that definitely, I'd say, was forming a new world order. obviously after World War One, that was also a new world order which was being created, but it really only materialized to be a more steady order after World War II. So there were different conferences and different events where these powers basically talked about this new world order, which means how can the international community cooperate and who is in the driving seat, and also the monetary system has typically to do with this kind of world order, because when it comes to international trade, which is important also, one needs to know in what kind of what the rules of the game are. So in what kind of money does one transact, and so on. So going to the perhaps more recent history, I'd say obviously post World War II, that was the obvious new world order, post World War II order, which we still have to some degree, but we did have the Cold War. And I think the important date in that context is also 1991, with the collapse of the Soviet Union, where the Cold War basically officially came to an end. And George Bush Sr. talked about a new world order being formed in the aftermath of the collapse of the Soviet Union. And we had this kind of US dominated world. That book from Brzezinski, the only superpower, it was called, basically alluding to the US as hegemon. This system has been increasingly rivaled with the rise of China, obviously, and also with Russia becoming more assertive and perhaps defensive, there, whatever way you want to look at it. And I think obviously in February this year, 2022, I think now the US officially has been challenged basically by Russia, not, at least not accepting the rules, or the West has been challenged by Russia, and they are not going to put up with the rules. And this is probably what this conflict between Russia and Ukraine also is about, in part, in the larger context. And so this newest world order, if you want to call it like that, post 1991, had a gradual decline, and I think this is now in the changing, and it will be very interesting to see how it develops.
Yeah, Mark, you made a few great points there where New World Order, yes, it can mean different things to different people. Absolutely, spot on there. But from a European perspective, being that you're in Europe, and you mentioned, we may change the monetary system or see a new monetary system, and things like that. Being over in Europe, how do you see this new monetary system, or what might it be?
I honestly think that that's also perhaps one of the biggest wild cards in the game right now, because if you listen to this classically thinkers of, I don't know, the Council of Foreign Relations and so on, I think that they don't really discuss a new monetary system. They think about these kind of topics in a military sense, probably, and perhaps an economic sense. But at least as the way I can follow it, I don't really think that they have a complete new monetary system on their card, and obviously they probably, from the West's point of view, they don't want to change the monetary system because it's also advantageous to being able to print the global reserve currency, for instance. But if this property suddenly is gone, or perhaps gradually decreases, that has implications, and that has grave implications on the power structure also, I think. So, I mean, this is a very complex thing. There's so many unknowns here. Nobody can know what is going to happen. But I think the monetary system is as it is. It's not sustainable. We see exponential growth in money. We see or in currency rather. We see exponential growth in debt, and this is another sustainable situation. And what basically, historically at least, did trigger a loss of confidence into a prevailing currency system nationally but also internationally is high inflation. So we're going there. I mean, it is quite high, I think, also in the West for the first time since decades. And the question is going to be how high will it get, or how long will it stay high? Because as long the longer it stays significantly elevated, at least, that will erode the confidence in these currencies, as I said, nationally but also internationally. And the higher the inflation gets, the higher the need for a new kind of monetary system at the end of the day, or monetary architecture at the end of the day on an international level will get.
If you're enjoying this interview with Mark Valek from Incrementum.li and I, please consider subscribing to our YouTube channel and giving us a thumbs up to let the algos know you want to see more content like this. And if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Yeah, I mean, you mentioned inflation, so I just want to take the time to ask you, how are things in Europe with inflation, with food, with fuel, and I guess it'll even go back into, the sanctions that the U.S. is imposing on Russia, and how that's affecting Europe.
They're bad. So inflation is the numbers are bad, and usually the numbers are understated. I mean, it's the number one topic in your typical conversation. Everybody's affected, and everybody is more and more annoyed, I think. Probably there is still in the general public a little bit of an understanding in terms of I think to some extent the spin is obviously it is all due to Russia, due to Putin, if you want to personify it, and somehow out of a act of solidarity, people are still willing to put up with. I mean, they don't have any other chance anyhow. But I think the blame is not sufficiently pointed to the creators of the currency, which is the central bank and the banking system together. And I mean, people, I think, are partly aware of that this rise of inflation clearly started long before the invasion of Ukraine. So they actually should know that that cannot be the sole source of this price inflation. But still, I mean, it's such a big topic. I think it overshadows all the other potential reasons, and it's a great scapegoat for politicians to point the fingers at somebody else, even though the problem, partly at least, is that they are responsible for the problem. But it's a big problem.
Yeah, absolutely. I want to get back to Rome here just a bit. Rome had a very established free market economy up until what was called a radical transformation, and that transformation was just not with wars, with the barbarians, but also with inflation and the diluting of silver, the silver content from coinage. What was interesting though was Rome devalued the silver coinage, but for a time, gold was exempt from debasement. Why was gold exempt for a time?
Well, that's an interesting side note to this inflation process. I mean, I could guess that first of all the gold was more obviously the store of value. That's well known, and as being the store of value, it was basically generally more for the elites. So I mean, one explanation could be the elites wanted to prevent themselves from diluting their own store of value, and kind of push the inflation more to the lower classes who use the silver as more as a medium of exchange. But at the end of the day, I mean, inflation is an insidious process. Basically, they also started diluting the gold coins, or debasing the gold coins, and they inflators, inflationists always get more and more sophisticated. And so, I mean, again, the parallel to today, they want to start central bank digital currencies that would make them extremely sophisticated in diluting our digital money. I guess that's one reason, perhaps, why they want to do it. So history always repeats itself. I mean, this is the crazy thing about it. People always try to obtain the monetary monopoly, and once they realize what kind of power lies in debasing the money and inflating, they never can stop. And the the insidious thing, I think, also about the process, that unfortunately, when you start the process, it seems to be a positive for everybody. So really, nobody gets hurt in the beginning. It seems so, and actually, the economy gets stimulated, even though it's an artificial boost and it's not sustainable. But at first, everybody's happy about it. Kind of, nobody complains. And at the end of the day, it oftentimes ends up that even the people who suffer the most of this whole system are calling the loudest for even more of the drugs. Yeah, and think about people protesting against raising interest rates. I think when in the last decade, when they started to raise the interest rates a little bit in the US, you had all kind of organizations like Black Lives Matter and so on. They were protesting, please don't raise interest rates, and keep them at zero. Uh, and but it's really the common man, I think, who suffers the most. But yeah, it's a very insidious process, this inflation debasement of currency.
Yeah, it's interesting perspective, and I completely agree. And I brought that up because when I read that couple paragraphs in your most recent in Gold We Trust report, I couldn't help but to think of the silver to gold ratio, where it's just getting larger and larger and larger. And I'm like, hey, this kind of lines up with what they did back then, where they kind of debased silver, but gold as a store of wealth kind of held its place. So I kind of made me wonder there. But anyway, Mark, most of that price inflation, as we kind of touched on before, came around 260, 270 AD, as you mentioned. And in many places, the monetary economy ceased to exist and traders had to resort to barter. Is it possible to barter today? And how would it look like? Or what mediums of exchange would we use to barter?
Well, barter, in my view, if you talk about like peer-to-peer transactions with the actual things you want to need, seems a very unlikely situation. I can't imagine that we are going to fall back to barter. I mean, typically in the last, I'd say, 200 years at least in modern history, even after hyperinflation, where you had a complete collapse of trust into the official medium of exchange, a new medium of exchange comes up pretty fast. It may not be the official medium of exchange. It may be kind of a black market, but the need for a medium of exchange is so high when you have an economy which divides the labor. So I think it is a pretty fast process, actually, to find a substitution that may not end up being the final solution, for new currency, but some kind of intermediary medium of exchange, I think, shows up. And if you think about today, especially when we have the internet, and I think that's perhaps a bright spot, generally speaking. I think a big problem also going back to Rome was that a lot of knowledge was lost. A lot of knowledge because it was centralized, and when society collapsed, this knowledge wasn't broadly available. And I think the internet is here a very good, obviously, backup plan for basically more or less all the human knowledge which exists. So I can't imagine that this knowledge is being wiped out and that people don't find out again. Okay, what could make sense for a new medium of exchange in such kind of event. So I don't really believe that we're going back to barter.
Okay, great point. I want to touch on gold here because there were also a number of interesting pieces that you had in your or in Gold We Trust report 2022. Considering 2019 and 2020 were outstanding years for gold, is gold still in a bull market, or are we seeing a long consolidation period once again, considering gold's lackluster performances following up in 2021 and so far here in 2022?
Yeah, it's true. We had great years 2019, 2020, and we had, to be clear, also a disappointing year 2021. And we addressed this also in our report. I think why was it disappointing? I think the performance 2021 in US dollar terms was minus 3.6%, if I'm correct. So it wasn't devastating, but it still was disappointing. Why? Because we actually had this price inflation creeping up all the time, all the entire year basically. It was, I think, in the middle of the year 2021 when the official price level was reached or breached as well in the Eurozone, but also in the US. So price inflation exceeded 2% in mid 2021 and kept increasing basically for the rest of the year, and thereby I think the disappointment actually also lies, because typically we understand gold as some kind of an inflation hedge, and so now you saw inflation and gold didn't do anything, more or less. So why was that? I think we can identify a few reasons for that. I'd say three minor reasons and one major reason. Starting up with the minor reasons is, one was US dollar was pretty strong, typically some kind of a headwind for gold. Two, which you already mentioned, we had quite strong years actually in 19 and in 20. So technically speaking, one can argue that gold was ripe for some kind of a consolidation. Three, if you remember back then, 2021 was a great cryptocurrency year. So you had a lot of talk about Bitcoin being the new digital gold and so on. And I think to some extent it stole gold the show. I mean, there were quite some significant volumes were invested, especially from financial investors in the US. Not huge in the grand scheme of things, but still, I think the market cap of Bitcoin increased almost a trillion dollars during the year 2021. So if you kind of add this kind of market cap to gold, which has a market cap of roughly $12 trillion, that's not completely insignificant. But still, we think the most important reason why gold disappointed in 2021 was the narrative that this inflation will be transitory. and we hear this narrative day in and day out by central bankers from all over the globe, basically, but also economists and most strategists adhered to this kind of narratives. And so I think financial investors, who at the end of the day still are, in our view, the marginal buyer or seller of gold, financial investors bought this narrative, and they never basically started to worry a lot about inflation, or at least that it could, about the possibility that it could be longer than anticipated, or even more severe. And they actually had a rude awakening in 2022. I think that's beginning of this year. That was the point when they slowly started to reconsider this narrative. But still, I mean, the Fed coming to this year, I think, did a good job to again keeping this narrative alive. By that, they are obviously starting to hike interest rates and talking about reducing the balance sheet. So I think just till today, I think that's probably the reason why gold hasn't done more. The narrative still is prevailing. The inflation will go away pretty soon, and yeah, that sums up our view what has happened on the gold market.
Okay, and noted in the 2022 in Gold We Trust report is that from 1989 to 2008, central banks were net sellers of gold and represented an important part of the global gold supply, averaging 400 tons per year. Now, since the great financial crisis back in 2008, central banks have become a reliable factor on the demand side now. And they look to remain as such on the demand side where they're before they were on the seller side. Does a decade plus of central bank gold buying say perhaps we never truly economically recovered from the great financial crisis of 2008?
I I would think so. I mean, I would first and foremost actually look at the monetary policy, because if you think back to the global financial crisis, what they did obviously is they started to expand the balance sheet. So the central banks I'm talking about, and that was unprecedented, at least in the most recent financial history of Western central banks. So when the Fed took its balance sheet from 800 billion to 4 trillion in a few years, that was a big deal, and nobody really in the beginning knew what to make of it. But if you remember back, they also said, okay, this is emergency situation, and we are going to normalize the balance sheet, and we're going to again increase the interest rates. Obviously, they were taken to zero. That was also an emergency step, and that was actually the plan, was that this should have been temporary, and it obviously took a whole lot longer than they initially said it would. But the interesting fact, I think, happened at the end of last decade. So almost 10 years after they started all these emergency measures, when they finally started to normalize, and that was a big buzzword, policy normalization, in 2016, 2017, they didn't really get far. They were able to reduce the balance sheet a few hundred billion. They were able to increase the interest rate, I think, to 2.5 percentage points from zero, and that's it. And then so I think the measure for a success would have been that if they would have been able to reduce the balance sheet, say at least back to 1 or 1.5 trillion, more or less, going to the trajectory where the central bank was going to go without the crisis. Then one could perhaps make the argument that these policies were excess and we have normalized and the interest rates are back at 3, 4, 5% at least. Then I'd say we could have, or these people could have claimed that we have recovered from the financial crisis, but we never were able to do that. And the next crisis started. I mean, we actually wrote about that in 2019, obviously not knowing that COVID will break out. But we specifically said we don't believe that this normalization will be able to manifest itself. And we are in a similar situation today again. So we're talking about, I don't know, normalization. I don't hear that often, but we're talking about, the Fed is talking about raising interest rates. They're doing it to some extent. They're still now only talking about reducing the balance sheet, but I guess they will start pretty soon. And they are actually planning to do it quite on a quite rapid pace. And we don't believe that this will be possible to do without a lot of suffering of the financial markets and also in the real economy, because we have become so addicted to these measures. So we rather adhere to the school or to the view that they can't stop. And no, to just go back to your initial question, no, we haven't even recovered from the financial crisis yet.
But having said that, what number do you think the Fed will get to? I mean, what is kind of your red light? 2.5%, 3%. I mean, what number is gonna kind of start to tell you, hey, put on the brakes. We better start turning around here.
I think it really depends on the markets, because I believe that the Fed is really serious about hiking. So I don't think that they don't believe that they can't do it. But I think they will go on as long as we only have some kind of an orderly decline in equity markets, for instance, or as long as we don't have credit spreads blasting out, because I think that would be really a dangerous situation. Uh, uh, and I think at that point of at some point of credit spread expansion or stock market crash, basically, I think they will have to backtrack pretty fast, because it's just politically not feasible to keep raising interest rates in an imploding stock market, especially when the public is highly dependent on these asset price valuations, especially if you have a baby boomer generation who wants to actually retire and live from whatever they have saved, and most of the savings is in the stock markets. So I think that the political pressure will become very high pretty fast if such a decline becomes unorderly or becomes some kind of a crash. And and that's something which we also write in this report. So I think they're gonna raise rates until it starts to get a little bit uncomfortable on the markets. I mean, it has become quite rough. I think 25 trillion US dollar globally in market cap has disappeared if one counts equity markets and bond markets having a very bad year this year to date as well. So this is a very bad situation for your general investment strategy, which has equities and bonds, both are in the red significantly this year. So we're not there yet, but I think we could get there pretty soon whenever the market sells off. My guess is it will perhaps be later this year, not like extremely soon. I think they will try to push yields higher once more and keep hiking once or twice more and talking tough, but we'll see when the market breaks.
Yeah, because you also mentioned in the in Gold We Trust report that Along with banks that are buying more gold in reserves, you noted that companies are also choosing to hold gold on their balance sheets. Is this why companies are also choosing to hold gold where they may see that the stock market may correct pretty heavily and they need some sort of other liquid asset on their balance sheets?
I think so. The qualities of gold are rediscovered more rapidly in an inflationary environment, obviously, than in a non-inflationary environment. And I think, coming back to your question, central banks being on the buy side of gold since 2008, and to some extent companies, obviously private individuals. Um, yes, this is a kind of a structural demand for gold. That's great, but still at the margin, we are of the opinion that for when it comes to determining what are the sources of price movements at the margin, we think it's the financial buyers or the financial investors. Anglo-American financial investor at the margin still moves the gold market. You can see that in the correlation between ETF holdings and the gold price. It's quite high. So when ETF holdings increase, the gold price increases typically, and vice versa. So even though that's not an enormously big number, if you consolidate all ETF holdings, that's between 3,500 and 4,000 tons of gold currently. I mean, it is a big number. It would be the second largest central bank if you combine all these holdings. But it is. I think the problem here is if these investors go in and out, typically they do it at the same time. So that's I think the price moving element in this kind of game. Whereas central banks, again, they've been continuously buying small increments, kind of, but not like all at once, right?
So I guess we are seeing central banks buying gold. We're seeing companies, businesses buying gold as well, and then of course physical investment demand. The retail investor is saw an 8-year high of some 1,180 tons being bought in 2021, but still we see gold prices unable to hold 1,900 level, much less the 2,000 level per ounce. Despite gold unable to hold that price point, at this point in history, would you say accumulating metals like gold and silver are still important?
Yeah, of course. I mean, at this point in history, it perhaps never was more important than currently. I'd even argue. I mean, obviously, one has to manage one's risk. One shouldn't go all in. I mean, it depends on the size of your overall portfolio. If you have a really big portfolio, then it makes sense to diversify more broadly. But I think gold allocation should make up a significant amount of everybody's portfolio currently. Perhaps just a comment, if I may, to what you said regarding consumer demand 2021. What I always find extremely fascinating is if you look at the numbers of the World Gold Council. I mean, India is obviously well known to be the largest consumer. At least it has been. I think it's now China may have overtaken it, but I think what one always could see is that the ETF and the demand and the like retail in the jewelry demand, sorry, which mainly is driven by India, has kind of a negative correlation. And that's I think a very interesting property also from gold, which basically dampens its volatility to some extent, because I think in cultures like India, where gold is so ingrained with the mentality, the way I view it is they buy always according to their purchasing power. They basically buy whatever they can get with the purchasing power of the rupee and the price of gold, obviously. So whenever gold falls, they buy more. and that's basically what happened in 2021. Gold prices fell or went sideways, but they actually were coming from a higher level in 2020 and were rather on the lower side. And the Indians they bought what they could buy, and they bought them, and it was a new record. Whereas the ETF holders were selling, right? So and whenever ETF holders, AI financial investors go in, then they can't buy so much on the jewelry side, and the demand drops. So this is really an interesting counter-cyclical element, which, as I said, is in the mechanics of things also partly the reason why gold has also a lower volatility than, for instance, Bitcoin. If you want to take that comparison, because Bitcoin has only monetary demand. It doesn't have any physical demand and no counterbalancing elements, and that's why I've been on records for a few years saying I can't believe the volatility of Bitcoin will ever go down as low as gold's volatility, as long as we are in a fiat currency system. But that's just as a side note. I find this fascinating that this is so anti-cyclical behavior.
Yeah, and when you mentioned diversification, as you kind of touched on here, you also believe that gold as well as Bitcoin, these are two things that can actually work together and don't have to be sort of mortal enemies here.
Exactly. Since 2016, I think we've included a chapter on Bitcoin, and we are friendly to it. I mean, we don't think it. We don't think that it's to some extent it is a competition, but still, I think it has just the properties are too different that it's 100% in competition with gold. So that's why also from a portfolio point of view, it makes total sense to put some Bitcoin into one's hard asset portfolio. We've been saying that since 2016 or 17, I think, explicitly in the report. We also offer some fund which combine precious metals and cryptocurrencies. And we were actually quite flattered to learn that last year, I think it was Ray Dalio basically said the same. He said he likes his gold with Bitcoin sprinkled over it. It's quite a nice analogy. So obviously one needs to risk manage that, and one should only do that if the portfolio has a certain size. In our case, we have a much lower allocation towards cryptocurrencies than towards precious metals, just because the volatility, the impact of a small position is large enough. If it rises, one doesn't have to go all in, and that's actually the nice thing about it, I think.
Yeah, that's a great point there. Mark Valek, before we wrap up, can you let our viewers know how they can follow you, how they can follow your work, and how they can contact you?
Sure. So we write the report, in Gold We Trust report, which is available for free on the internet webpage www.ingoldwetrust.report. It's available in German, English. It's coming up in Mandarin again later this year, and this year also first time in Spanish, the compact version. So we added a language this year again. And if you want to have a look at our homepage, it's Incrementum.li, and then you can see what we are publishing and what we're doing on the fund side if you're interested.
Okay, so a free publication now coming out in quite a few different languages. There's no excuse for us not to go ahead and read it anymore, right? So, all right, Mark Valek, we appreciate the time you've given us, and I hope we can do this again soon.
Thanks for inviting me, Patrick. Have a great day.
That was Mark Valek sharing his views on economic history and precious metals. For more info on Mark, please visit Incrementum.li. If you like this video, please give it a thumbs up, subscribe, and share to let the algos know you want to see more of our content. Audio-only versions of this interview can be found on iTunes and Spotify.